Welcome back. On the last show we covered residential mortgages. And for those of you who are tuning in for the first time today, let me just recap the important aspects of residential mortgages and then we'll go on to commercial property. So when you're taking out a mortgage, you first need to find out 1. How much you can afford to borrow, what size of mortgage you can get, and how long your mortgage will last. The interest payments on mortgages basically fall into two main categories, variable and fixed. A variable rate can change from month to month, and you can't be exactly sure what your repayments will be, whereas with a fixed rate, you know what your monthly commitment's going to be. And depending on the country you live in, you can fix for 1, 2, 5 years, or even the life of the loan. So remember, this is a huge financial decision. Take your time, do lots of research. Get quotes from several lenders and try to negotiate their fees. Make sure you can afford the mortgage, even if your costs do go up considerably, and don't overstretch yourself. Examine the pros and cons of the fixed rate versus the variable rate, and if you'd like more certainty, opt for a fixed rate. If you do decide to go for a fixed rate and you want the flexibility of being able to make overpayments or to pay lump sums during the fixed term, make sure you set it up in advance with your lender. I can remember that each time I decided to go for a fixed rate, usually just for a year or two, I always had to pay these horrendous penalties for getting out of a fixed rate deal because I thought when I took out the mortgage that I was going to stay in the house forever and a day, and I hadn't set up more flexible terms in advance with the lender. One of the properties that I bought was simply gorgeous. Nothing had to be done to it. I moved in, felt comfortable, it was mine. I had a housewarming party for friends and relatives, and everybody came to celebrate my new house. And 6 months later, 4 students wanted to rent my house for way more than I was paying for my mortgage. And I had a tiny, tiny house in my portfolio that had just become vacant. So I gave these 4 students this gorgeous house, and I moved into the tiny house. And then I had to pay all these penalties to the bank, not only because I was getting out of my fixed rate mortgage, but also because I was changing the mortgage from a residential one to an investment one. So take the time to think up all the possible changes you might like to make at the outset, and then try to negotiate this with your bank. Otherwise, you might find yourself paying hefty penalties down the line. Now let's talk a little about mortgages on investment properties. The type of loan for investment property is called buy-to-let in the UK or non-owner occupier loan in the US, but it is a very different type of loan from your main residential property, as this is more like having a business. You earn rental income from the property, and this is what pays your mortgage. Now, most lenders offer these types of mortgages, and the lending criteria is based on the amount of rental income that the property is likely to generate, as opposed to your income. A deposit of at least 20% or more is required, and rates are slightly higher than for residential mortgages. Now, for people who want to invest at this time and in this economy, I recommend being very cautious about those investments. If you can buy the property for cash, and you can hold on to it for years at a time and not worry about losing your investment, go for it. For other people who are looking for an income on your investments and doing so by way of mortgaging that property, I don't think this is the time to do it. But let's look at the investments that were made years ago and see how they played out. The first property that I bought when I applied for my mortgage, the bank told me I could only have a mortgage for this one property. 8 months later, I sold that property for a substantial profit. And that same bank then let me have 2 mortgages on 2 other properties. And as long as I was making my mortgage payments on time, they decided to let me have more mortgages. So within 7 years, I went from getting a mortgage on my first property for £68,000. And by the time I got out of the property business 7 years later, I had a very substantial portfolio with many, many properties worth millions of pounds. When you owe a small amount of money to the bank, chances are they're going to repossess the property if you can't make the payments. However, if you owe a huge amount of money to the bank, they'll do everything they can to help you make those payments and to give you more loans. The point of it is, if you're a small-time investor, just buy what you can afford to pay. And if your risk assessment shows that you're a high-risk taker and you have the funds to at least make a running foray into the property business, you'll find the banks very willing to give you as much credit as you need because they cannot afford to let you lose. Had an email from JK last week. He says, I've been turned down for a mortgage 3 times now. What would be your advice? Well, thank you for your letter. Firstly, check out whether your income supports the amount of mortgage you're applying for. Then I would get the credit agencies to send you a copy of your credit report. It may be that in addition to the mortgage payments you will have, you're also spending a lot of money on credit card debt. That could be one of the reasons that the banks are turning you down. Your resources may be very limited. I'd look into getting a mortgage broker. Ask them how many lenders they deal with. Are they fully independent? And are they willing to search for the best deal for you? Next week, we'll be discussing home improvements. From upgrading your home for personal pleasure to renovations on your investment property, which will generate more rental income and capital value. See you next week.